The one big beautiful bill act that passed in the summer of 2025 made the Tax Cuts and Jobs Act's federal tax brackets permanent, which, as tax planners, gives us a little bit more breathing room. It's not an opportunity to say, let's do nothing, but rather an opportunity to think a little bit more strategically and proactively.
Yes, we'll talk about how this extension affects how we as planners think about things like Roth conversions, general tax planning strategy, and just most importantly, how tax planning isn't a one and done event in a plan.
So, in January of 2026, until this last summer, we were expecting tax rates to go up, but they didn't. And so we celebrated by spending some time in Costa Rica.
Generally, the J months, so January, June, July, just tend to be a little bit less busy. People just, they're settling into the year or it's summer and they don't want to talk to a financial planner. They want to go golfing or, whatever it is you do. I don't golf, but, I know what it is to enjoy summer. So,
Yeah, actually, there were surprisingly few golf courses that we saw in Costa Rica. Maybe we were just in the wrong spot, but maybe not your ideal vacation if you're a big golfer. But for us, we just we didn't rent a car, so we also didn't spend much time more than 2 miles away from where we stayed. But got a lot of sunshine, spent a lot of time at the beach, hung out with our baby. It was a great time.
it was wonderful. Yeah. Yep. And then we ramp up in the spring and the fall. Those tend to be our, heavy, deep thinking, intensive periods of work and planning.
Yeah. So tans are fading, but I think they're still here a little bit from Costa Rica. Now that we've got done celebrating lower taxes in 2026 and beyond, we're back into it. And yeah, today we're just going to deep dive a bit into what this really means and how it impacts tax planning both in 2026 and beyond. Because as we said before, tax planning isn't a one-time event, and neither should your financial plan be.
Yeah. So previously, the tax rates that we had were set to sunset or expire, right? So, 2025, they were set to expire or change and increase, right? So tax rates increase. So we were adjusting our planning, around this and evaluating for clients. What does this mean for you? Should we, pull this lever or this lever because our current brackets, right? The 10%, 12%, 22%, 24, 32, 35, and 37% marginal brackets, they were set to increase, right? And so our favorable brackets, do we need to soak up any of these rates? Do you have any wiggle room right now? Because we might be reaching a cliff. At least that's what it's looking like in legislation. That's what we're being, told. And so we were planning for this.
Hmm.
Now, as we've said, that expiration, that sunset is extended. So for the foreseeable future, next couple of years, we have these favorable rates extended.
Yeah, and maybe even just to double click on what planning looked like 2, 3 years ago. Our software had this sunset built in because that was what we knew of the future. That was what was expected before legislation in 2025 changed to that. So, this can be swings of hundreds or thousands in a single year for a client, depending on what their tax bracket is.
Mhm.
Then, of course, as you start to blow that out over years, that effect multiplies. So yeah, so planning in 2022, 23, even 24, as we were starting to hear rumbles of, oh, maybe there will be a legislative change, there's quite a big pivot point on what actions you took before the end of 2025 versus afterwards.
Yeah, and now with this extension, we just have more planning runway. And so it just kind of extends some of these strategies that we've been employing, or maybe we even spread them out a little bit. We're not trying to squish it into it, a certain timeline because we're trying to avoid that cliff. So it affects the plan. And again, this is why planning isn't a one and done event. It's evolving and changing. And so this extension has given us more time to, implement some of the strategies versus trying to, really make a lot of different moves or, for example, a rock conversion before they were set to sunset.
Yeah, and I think that's the first big point, right? Especially if you're a current planning client of ours, you're not going to stop hearing us talk about Roth conversions if it's something that's a part of your plan. Rather, we're just looking at it a little bit differently. Instead of kind of having a pre-2025 and a post-2025 environment. Now 2026 from a tax perspective is much the same as 2025, just with, kind of regular small increases, but the actual percentile of tax is not changing from a federal perspective. So, we'll talk in a moment about how permanent doesn't mean permanent, but
Yeah, and I'll also just add in there, Roth conversions don't always make sense. In fact, it's a very case by case basis. It's just a really good example when you have tax rate changes to see, do I have favorable rates right now, tax bracket rates? Do I have wiggle room in my current bracket that's favorable to soak up? And how would I soak upwards? A good example is a Roth conversion. Doesn't make sense for everybody,
Mhm.
but it's a really good example.
Yeah, no, 100%. And you use the term favorable, and I think that's a good place to even rest for a moment. So when we say that it's a favorable tax rate, what do we mean? I think to zoom out for a second, federal income tax in the United States. I won't go like into a deep history lesson, but it's changed a lot over time. A lot has changed about the tax code. Back in the 20th century, there were times that the top tax bracket was quite a bit higher than it is currently. And, you can get into all sorts of detailed arguments about what loopholes existed or didn't exist. But net, we are in what the consensus would say is a favorable tax environment, meaning federal taxes are by and large lower than they historically have been, when you account for all different sorts of variables and factors. A lot has changed, a lot could change in the future. But when we say we're in a favorable tax environment, that's what we mean. Looking historically, taxes are generally lower than they have been in the past.
Yeah, absolutely. And so if we are in a favorable, depending your income or, different, we'll talk about all the variables that can change if you're selling stocks or you have a bonus or, all these different income levers, depending on where you fall, it could be a favorable set of years for you to look at manipulating your income and or, using some of these favorable tax bracket rates saying, "Hey, I've got 50,000 of wiggle room before I hit the next tax bracket." And, we make a shift from your IRA to your Roth, aka a Roth conversion. Again, they don't make sense for everyone. It's just a lever that we could pull in a plan if we weigh the tax benefits now and in the future.
Yeah, exactly. And I think that underscores an important framework that we're often thinking about, which is deciding to pay tax now. As you've said a couple times, it doesn't make sense for everybody. It doesn't make sense in every plan by any means. But when you decide to pay tax now, you take an uncertainty of the future and make it certain in
Mhm.
the now. So, talking specifically about the US right now, we've got retirement funds, the two major tax treatments of Roth, tax free, and pre tax, not yet taxed. By moving more into Roth, you are increasing the amount of certainty of tax treatment in the future and decreasing the amount of uncertainty. When you're 25 years down the road, tax brackets could be lower. I don't know. They could also be higher. One thing that we continue to watch is the US deficit, and there's a lot of different ways you can cut at the deficit, but another kind of consensus item that's emerging is we're going to need more money in the future, and income taxes are certainly one way that we can acquire more money as a federal government. So not not trying to fearmonger, but just saying like okay, when we're thinking about tax strategies, big picture, we're thinking about moving uncertain taxation in the future into the present and into certainty and taking an element of tax risk off the table.
Yes, we're trying to take a calculated risk to increase certainty, to increase flexibility. And yeah, US deficit, if the US needs to raise revenue, a lever they could pull is raising taxes. That's just the truth. And whether they do that or not, we don't know, but also just think about people who have all of this pre-tax money, from their employer match or IRAs or 401k money they had in pre-tax. Ultimately, what we can look at and see is this money hasn't been taxed, so you're going to have to pay tax through an RMD even. And when you take that, guess what happens? You take out your own money and it's counted as ordinary income. And when it's counted as ordinary income, you get put into whatever tax bracket, it can be very high that ultimately your money forces you into. And
Yeah.
so again, we can know certain things and try to take that off the table as a risk and move money into, a place where we can say, "Hey, we are de-risking the plan in this area.
Yeah. Yeah. Risk is a great framework to think about it through. Cause I think sometimes places like Reddit or Facebook comments want certainty or want simple answers. This is a little bit intentionally vague because there isn't a simple answer. Really, we're
Mhm.
talking about spreading out risk appropriately within your plan. Having too much money in Roth can be a risk. Having too much money in pre-tax can be a risk. It just depends on the variables of your plan for us to figure out what's the most tax diversified strategy for you as an individual.
Absolutely. Tax diversification. What percentage do you want in Roth? What percentage do you want in pre-tax? What percentage do you want in taxable? What percentage, and specific to you and your goals, of course, but looking at it through the lens then of current legislation, current tax rates. And right now, with this extension, this is a great topic for, a lot of our clients.
Yeah, and I mean, even just a couple other factors to mention in the name of education, not advice. But another reason this is very personalized is if you're thinking about retiring, you're thinking about living internationally for a while, perhaps as a permanent resident.
Hmm.
Note that Roth is a U.S. construct, and that means that it is treated sometimes differently in different countries. So, if your plan has you going 100% Roth, and then you really want to move to a country where Roth is not recognized, that actually could break your plan.
Yes. So, I'll just share. I am I really like a plan with a lot of Roth money and a lot of taxable money. Because it's known flexibility for me. And so it just creates so many windows and opportunities. So I will, disclose I really like a plan with high percentages of Roth and taxable. That said, if I knew, and how would I know this unless you're my client and I'm asking you these questions? But if I know, and I know of some clients who want to go live in another country for an extended period of time, or if they want to retire there, then we need to know that, because ultimately then Roth might not be, the right choice, because it's not recognized as tax-free in other countries. And so we've been foregoing this deduction all these years for what? Money that you're going to be taxed on again. So yeah, great point.
Yeah. Yep. So tax planning, I would say it's one of the most important things that we do at Abundance, as this episode is uncovering.
Yep. So important. Tax planning, key to financial planning. And if any of this is catching your interest, tax planning and a financial plan, or you're wondering if your financial planner is doing this kind of analysis, running tax planning, if it's piquing your interest, then, go ahead, reach out, and we still offer free consults at this point in time. And so you can go on our website, book a consult, and we can talk about, if you're getting this addressed. And I'll be able to, lead you through a series of questions too, and kind of highlight, what are the problems, or maybe what your financial planner is or isn't doing, so you can kind of know where you stand.
Yeah, it's actually quite common for us to talk to people who have some kind of financial professional in their life. But I would say this is one of the points of differentiation where some financial professionals are steeped in tax planning and some aren't. And some people might not need tax planning or be in a place where they don't feel they need a lot of it. But for others, it can be a really, really big lever in moving their plan in a positive direction if it's properly attended to.
Yeah, and we're just trying to save people money. And a good way to know if your financial planner really is involved in tax planning is how much communication they have with your CPA on your behalf. Because I know that big dollar signs can be saved when we're coordinating with CPAs and making sure that everything is working together. So yeah, it's an art.
Yeah, 100%. Okay, so let's round out this episode just talking. This is actually chunky, so maybe I shouldn't say round out the episode, but let's talk about how tax planning is done on an annual basis. I know at the start we said you can't just tax plan once and say, "Great, we've done it, we're done, forget about it." So we're going to go through a few things that are all media analyses in themselves that help us stay current on a client's tax plan and then make adjustments as needed. The first piece we look at is income trajectory. And while that might seem straightforward, it's more than just salary and bonus. We're also looking at things like planned or expected asset sales, like a home, or perhaps highly appreciated company stock. Certainly in the environment in the last few years, we've seen some stocks, particularly in the tech space, appreciate greatly. And those sales affect your capital gains tax bracket, which we'll talk about in a moment. Are there passive income sources? What does state tax look like for the client? So these are all things that affect any kind of conversion strategy and need to be rock solid. So for our planning clients, we're making sure that we are really, really highly tied into any sort of income moves that they're making in a given year.
Yes. If this, then that. Every move can have a consequence, an outcome, and ultimately, this is where planning gets so interconnected. Well, like I've always said, but because that's the truth. It's every move can affect different parts of your plan. So, and you just want it all working together. So, an example of this, I immediately think of this client that I know, Ben is thinking about, and um, she's a total rock star, and we're looking at her plan, practically for the year, and it on paper, looking at her income sources, right? On paper, we were analyzing and found it would be an ideal year for her to make a Roth conversion, right? Shift some money, kind of deflate the pre-tax balloon, soak up an ideal bracket that she had wiggle room in her what ordinary income bracket, right? But again, if this then that, we also have to look at her capital gains bracket. And she had realized so she had sold a stock and realized some long-term capital gains. And if we would have made a Roth conversion, which on paper, oh, we have wiggle room, but if we wouldn't have looked and seen that she, had realized some long-term capital gains and just gone ahead with that, she would have owned more money on the stock sale at the end of the year than she would, 5% more. And so because this is where it gets interconnected, the ordinary income bracket versus the long-term capital gains bracket, how do these interplay and talk to each other and affect the other? And so we actually decided, what, we're not going to do a Roth conversion this year, and saved 5% of taxes that she would have owed, which is a significant amount. And so that's where even sometimes on paper, you could say, well, here, let's do a Roth conversion, but we don't know, here's what else happened throughout the year. And that's where you have to be really thoughtful on how you're going to plan, make these moves, how you can save your client the most possible dollars, in your tax, also weigh it against, what we're looking at projected for long-term tax, and it's a dance, it's connected.
Yeah, and I think that's where an early year, late year cadence tends to really help. So early year, we are getting a lot of good base information. And yes, in this client's case, via the early year projection, things looked pretty good for a Roth conversion. It looked like it made sense for her with her plan. But things changed. She made a couple stock sales that the stock was just more appreciated than we expected. Falls in the good problems category, right? But then pulling some more precise data toward the end of the year to really round out the tax picture, we see that little capital gains torpedo where really realizing any extra income, every extra dollar was going to push another dollar of her capital gains into the 20% tax bracket. Really inefficient, especially looking at her plan. So yeah, it matters to check and then check again and then really make sure that you're getting all the information you need from clients. So
Yeah.
that's one piece. Of course, income is a huge piece of tax planning. But other factors that we want to look at, particularly for retirees or early retirees, there are various thresholds for Medicare premium surcharges. IRMAA is the common acronym. Social Security taxation can also be affected by your income. So we don't want to just look at federal tax brackets, because if we're not looking at IRMAA, which also has a 2-year look back period, and we're not looking at income for Social Security taxation purposes, we can start to have some inadvertent inefficiencies in the plan. So those are important things that we're checking as well, particularly for those that are in that 60 plus phase of their lives.
Yeah, my mind tends to go towards accumulation planning because we work with a lot of, just high powered, high income earning accumulators. And so that's where, how can we manipulate income? But when you get to retirement, that planning is so important because you are now creating your income source. So how are you going to manipulate it from there? And you can save even this year with, what Ben's talking about Medicare. I mean, pre-Medicare health expenses. If you keep your income under a certain level, you can pay significantly less for healthcare.
Yeah, I guess I didn't even mention that one, but yeah, pre-Medicare premiums too are very sensitive to income. So IRMAA is progressive surcharges as you go up in income. ACA, so if you're pre-Medicare age and retired, or just purchasing on the ACA marketplace, there are now, as of 2026, this one did change. There are cliff subsidies now. So you can literally, and I mean literally because we saw this for a client, you can have a 5 figures over $10,000 premium swing based on landing $1 over or above 400% of the poverty level.
Yes. We have a couple clients actually, who this year with that rollout, again, being aware of tax changes, legislation changes, and how it affects you, so important because yes, I had a client this year and we saved over $10,000 for them in the year just by changing how they took their paycheck.
Yeah. Yeah.
How we created their paycheck in retirement, what accounts we were pulling from. We saved them over 10,000. I think it was 13,000 in healthcare premiums.
Yeah. Yeah. So I mean that's where strategy gets real. I mean the other things then to look at, these are more about keeping our ear to the ground and just being smart as circumstances evolve. So when we're doing tax planning, the investment performance and market environment actually does affect that. This is really going to be like niche to your circumstance, but market drawbacks can be a nice time to convert if your plan is in a position to do it. Say you've got a $1 million IRA, drops to $850,000. That's $150,000 of untaxed liability that's off the table. Might be a good time if your plan supports it to take more of that before the market likely, we don't know the future, but likely corrects back upwards.
Right. So think about it. Your IRA, money that's going to be taxed in the future, drops. Okay. So market's down. You can convert that money from the IRA into your Roth IRA, which is also down. And so you're still buying at a low. You're going from one account to another, a different tax house. And then let's assume the market does correct, right? Which we generally believe the market does correct. We don't know when and how long, but when it corrects, that Roth money that you got into that account then is growing, right? And coming back up and growing now tax-free. So it actually can be a really strategic move.
Yep. Yeah, and I mean, the reason I give it some caveats is we don't want to get too far into timing the market.
Yeah.
You never know when you think you bought the dip and you just bought it right here and then it's way down there, right? But strategically, right, we do watch the market, and there are people for whom opportunistic conversions make sense.
Yeah.
The other thing we've been talking about is actually the impetus of the episode, but we have to be mindful of legislative and tax policy changes. So yes, we have permanent federal tax brackets. That's permanent until Congress changes them. So Congress surely will change them in the future, and we surely will be watching. So here's the bottom line of this episode. The One Big Beautiful Bill Act made the Tax Cuts and Jobs Act's federal tax brackets permanent. We've gained some planning flexibility with that, but that doesn't mean the opportunity for action has gone away. It simply means that we've got an extension of favorable rates and variables to play with. Smart Roth conversions and tax planning aren't about reacting to a cliff or reacting just to legislation. They're about proactively building a plan, and that plan isn't static. It's iterative and evolving year over year.
Absolutely. And we believe that's what your financial plan should be as well, is iterative and evolving year after year, just as your life does. As your life moves, as legislation moves, and as tax rates move.
Right. So if this is you, don't hesitate. Feel free to book a consult, and we look forward to digging into your personal picture to see if tax planning makes sense for you.